Silver just broke the rules. For decades, $100 was the wall, the ceiling, the psychological cage, and now it's gone. Silver didn't just cross $100. It traded as high as $115.59 spot and over $110 in Chinese futures. That's not a headline spike. That's the market accepting a new regime in real time. And here's the contradiction that matters to you. The moment an asset turns triple digit, it stops acting like a bargain and starts acting like gravity. It pulls capital in, not away. That means the old playbook, wait, hesitate, I'll buy the dip, can fail fast. If you're still hoping for $90, you may be waiting for a price level that never comes back. But here's the part nobody is saying out loud. In this cycle, even selling can break. The core event is simple, but the pattern underneath it is bigger than silver. The $100 barrier wasn't just a number. It was psychological containment that held for decades. And now that containment is gone. The market has moved into price discovery, meaning there's no historical ceiling memory left to slow it down. Silver has already shown the new range. $100 is behind it. $115.59 has already printed, and triple digits are being normalized day by day. Now watch how fast this escalates. This breakout doesn't behave like a slow value re-rating. It behaves like a momentum machine. It compresses time, forces decisions, and punishes hesitation. You're no longer watching a metal drift upward. You're watching a system shift gears in public. And once that happens, the crowd doesn't ask, is this cheap? They ask, how do I not miss it? Notice what they didn't deny. Nobody is treating $100 like a peak anymore. The debate has already moved to targets. $150 within weeks, $200 in coming months. Not because everyone suddenly became optimistic, but because the speed itself is rewriting what feels possible. So the real question isn't whether silver should be above $100. The real question is, what happens when this becomes the new floor and the next leg forms before you even realize the old cycle is gone? Silver is no longer moving in polite increments. It's moving in compressed bursts, and the numbers show it. The move from $20 to $30 took 145 days, but the move from $90 to $100 took just 10 days. That isn't a normal bull market rhythm. That's time collapsing under pressure. And once time compresses like that, the market stops feeling tradable and starts feeling inevitable. Here's the strong claim. This is a melt-up structure, not a forecast, a behavior pattern. When price climbs fast enough, liquidity doesn't just follow, it disappears. Buyers rush in, sellers pull back, and every small gap becomes a jump. That's how $10 becomes a weekly event and then a daily risk. It's why predictions can suddenly talk about $150 within weeks without sounding insane inside the moment. But here's the part nobody is saying out loud. When silver moves like this, the biggest danger isn't missing the upside. It's making decisions at the wrong speed. If you wait for slow corrections, you might never get them. If you chase violently, you might buy the emotional top. Notice what's missing from the old playbook: a stable re-entry zone. Under $100 used to feel guaranteed. Now it's starting to feel like a memory that the market is deleting in real time. And once the market deletes a level, it doesn't ask permission. This is where the story intensifies, because the breakout isn't just price, it's behavior. Triple-digit silver creates a new kind of demand that rises as the price rises. Not because people understand silver better, but because they fear being left behind. That's how a market stops acting like a hedge and starts acting like a headline-driven stampede. Now watch how fast this escalates. The material describes a whole new universe of uneducated buyers entering the space, pulled in by momentum and the visible erosion of the dollar's purchasing power. This is the Veblen good effect in motion. Higher prices don't slow demand down. They validate it. And that means every new high becomes advertising. Here's why that detail changes everything. In a normal market, higher price invites more selling. In a frenzy market, higher price invites more buying, and selling starts to feel risky. That's how inventory disappears, even when dealers are buying 6 figures worth of product daily. It's why showcases stay empty. Not because metal is gone from the world, but because it can't stay on the shelf long enough to be seen. And this is what becomes normal in the worst possible way. Scarcity becomes part of the price. Premiums stop being an inconvenience. They become a permanent tax on access. So the question isn't just how high the spot price goes. The question is how quickly the physical market turns into a bottleneck that reshapes everything you thought buying and selling would look like. Now the second proof hit lands, and it's more disturbing than the price itself. Because while everyone stares at charts, the physical supply chain is quietly failing in a very specific place. Refiners have effectively stopped buying alloyed silver products, 90% junk silver and sterling. Some refuse entirely. Others impose payment delays from 10 days to 3 months. That's not a minor inconvenience. That's a structural warning flare. Here's the contradiction that changes how you see this market. The melt value can be rising while your real-world liquidity is collapsing. On paper, 90% silver should feel like a bargain when spot is screaming higher. But dealers don't live in theory. They live in cash flow. They rely on speed, rinse, wash, repeat. If they can't move your product to refiners quickly, they can't tie up capital. So they stop buying, or they discount aggressively, or they delay payment. Notice what they didn't deny. They didn't say the metal isn't valuable. They signaled the system can't process it at the pace the market now demands. And that creates the worst kind of trap. You can be rich in price terms, but stuck in exit terms. This is the line that permanently changes the viewer's understanding. Not all silver is equally liquid in a crisis bull market. 0.999 fine bullion stays movable. Legacy silver can become a bottleneck asset. So if your strategy assumes you can always sell quickly, you may be building your position on the wrong foundation. Now stack the developments, because this is where pressure turns into loss of control. First, the market speed is compressing decision time. When $10 moves can happen in days, hesitation becomes an actual cost. Second, retail mania is draining inventory instantly. Dealers can buy 6 figures worth of stock and still watch showcases stay empty. Third, the supply chain is breaking in a way most people don't notice until they try to exit. Refiners aren't absorbing alloyed product, and cash conversion can take weeks or months. Now watch how fast this escalates. The market becomes selective. It doesn't just reward owning silver. It rewards owning the right kind of silver, in the right form, at the right moment. 0.999 fine stays liquid. Everything else starts carrying friction. And that friction spreads quietly because dealers start protecting their own survival. They prioritize fast-turn inventory. They tighten buybacks, and they avoid anything that slows the loop. But here's the part nobody is saying out loud. When an asset turns into a stampede, it's not just price that spikes. It's system stress. And system stress creates rules you didn't agree to. Longer waits, wider spreads. We're not buying that right now. Come back next week. Payment takes time. What happens if this continues? You don't just get a higher silver price. You get a market where access and liquidity become the real trade, and the metal becomes harder to use when you need it most. This is where it's the real world, your world, because when silver crosses into triple digits, it stops being a niche conversation and starts becoming a daily life decision, not just for traders, for ordinary people trying to protect purchasing power while everything else feels less stable. If you're buying now, you're not just competing with experienced investors. You're competing with momentum buyers who don't care about premiums or timing. They're buying because the number on the screen looks like a warning signal. And when those buyers arrive, the physical market becomes crowded, impatient, and expensive. Even if you're calm, you get pulled into a system that isn't. This is where the story flips. Your risk isn't only, did I buy too high? Your risk is, can I still buy it all when I decide to act? Dealers report inventory being gone as fast as it arrives. That means your plan, dollar cost averaging, waiting for dips, moving slowly, can get overridden by scarcity and speed. And if you're holding the wrong form, you face a second problem. Liquidity may not match the spot price. If refiners delay payment for 10 days to 3 months on certain product, then selling becomes a process, not a button. If this feels familiar, say so in the comments, because this is what markets look like when insurance turns into a crowd event. It feels exciting until you realize the system starts choosing winners based on timing, access, and friction. And that's when owning silver becomes less important than owning optionality. Now step back from the adrenaline and look at the mechanism, because this is where the story gets smarter than the headlines. What's happening isn't just silver is up. It's that incentives across the system are flipping at the same time. When an asset enters price discovery, volatility becomes acceptable, even expected. When retail demand becomes headline-driven, scarcity becomes self-reinforcing. And when physical pipelines clog, the market starts paying for liquidity itself, meaning the spread between what you can buy for and what you can sell for becomes a hidden tax. Here's the calm but unsettling insight. Markets don't break all at once. They break at the seams. The source material shows that clearly, with the refiner refusal and delayed payouts for 90% and sterling. That isn't a price story. That's an infrastructure story. And it tells you something deeper. In this cycle, the most valuable asset may not be silver alone. It may be silver in a form the system can still process quickly. Now watch how this shifts power. Dealers become gatekeepers. Relationships matter more than charts. Regular clients get priority. Walk-in panic buyers get whatever is left. And institutions signal their expectations through pricing behavior. Like the US Mint pushing proof silver eagles to over $170 per ounce, effectively broadcasting a higher baseline. This isn't just money chasing metal. It's the system re-rating what real assets are worth under pressure. And once a system re-rates like that, it doesn't return to normal quietly. The near-future trajectory now comes down to momentum versus friction, and both are rising at the same time. On one path, the melt-up continues. Speed accelerates, buyers multiply, and targets like $150 start feeling less like predictions and more like checkpoints. If silver can move $10 in 10 days, then weeks can do what months used to do. That's the momentum path, compressed time, vertical moves, and a market that punishes hesitation. But there's a second path forming underneath it. Structural stress. The physical pipeline doesn't expand overnight. Refiners don't magically speed up. Dealers don't suddenly gain more working capital. And if liquidity is already selective, 0.999 fine moving cleanly while legacy silver slows, then higher prices can widen spreads and make exits harder, even as the screen price looks impressive. Here's why that uncertainty matters. You can be right on direction and still get trapped on execution. You can be up on paper while dealing with delays, premiums, and scarcity in the real market. That's why the smartest behavior isn't just optimism or caution. It's positioning for both outcomes at once, respecting upside momentum while reducing the risk of friction-based failure. And the next move is already forming, because as soon as triple digits feels normal, the market's attention shifts from did it happen to how high is next. Here's the deep insight that ties the entire story together. The $100 breakout isn't just a price event, it's a behavioral regime change. Below $100, silver could still be treated like a decision, a trade you could postpone, a chart you could revisit next month. Above $100, silver starts behaving like a signal about fear, currency confidence, and system stress. That's why the market moved into price discovery. That's why time compressed. That's why the crowd arrived. And that's why liquidity started splitting by product type. The most important sentence is this: in the next phase, the winner isn't the person who predicts the top. It's the person who can still act when the system gets crowded. The metal becomes less about being right and more about being positioned before access narrows. So if you're playing this intelligently, you don't panic buy, you don't freeze, you prioritize liquidity, you avoid the trap assets, you think in exits, not just entries, and you treat this like what it is, not a normal rally, but a market that's rewriting its own rules in real time. If you want deeper scenario planning, melt up, structural grind, or liquidity trap, follow and subscribe, because the next layer isn't about how high silver can go. It's about what breaks first when it does.